Welcome back to the channel. It's Evan Clementino here at C+B, and as I promised, here's another video on the profit and loss statement. In my first video, I covered the absolute basics, what the account should look like and how it should be listed out, how to read it, and how to identify whether yours is in good shape or not. Now today, we're gonna get more technical. We're gonna go into the numbers of it. Don't worry, it's not gonna be too deep, but I'm gonna show you how to finally be strategic with that profit and loss. And that means taking a look at it and knowing how to act to make those numbers more attractive and work in your favor. Let's get right to it. This is the profit and loss statement from the previous video here. So nothing has changed. You can see you have 815,000 in revenue. That's the number that everyone loves, but let's get into it. Here you have your cost of goods sold at 441,000 for a gross profit of 374,000. Those are your direct expenses. Remember, these are the expenses that are attributable to a specific job. Then you have your operating expenses, or what we call overhead. And these are the expenses that are not attributable to one specific job. Rather, they are incurred regardless of the level of work that you do. And for this company, over the year, they incurred 211,000, almost 212,000 in overhead expenses, bringing them to a net profit before tax of 162,000. Then you include your tax, estimated 15% tax rate, and here you have a net profit after tax of 137,000. Not bad, okay? Now, you may be looking at this and saying, okay, how does this apply to my business? Well, first of all, I encourage you to grab your profit and loss statement. If you don't have it in front of you right now, go ask your bookkeeper or your accountant, or go into your QuickBooks account, hit reports, search in income statement or profit and loss statement, once you toggle the dates, just download that report and you can follow along with me. You can see right away how your company stacks up compared to this one. And that's not to say whether this one is a good or a bad one. It's just to give you some reference, right? And one of the first things that I'll have you do is convert everything into percentages of revenue, because this is going to allow you to compare one company to another, even though the revenue, the cost of goods sold, or the overhead expenses may be completely different. So it's really easy. I just take every number and I subtract it, or I divide it by the total revenue. You put that into your percentage format, and then you can compare across every category. So as you can see here, just roughly some of the ones that catch my eye here: your revenue, your contract revenue makes up 93% of your total revenue. Okay, your direct materials and labor are 17 and 34% respectively. And your cost of goods sold, that is the direct expenses that go towards each job, is 54% of your revenue, okay? Then we look into overhead, and obviously you can see all of them are below 10%, but I wanna know which ones are the most and least impactful. This one here, your salary as the owner, is 9%. Just to take a little side quest quickly, I mentioned in the last video that your salary might be able to be attributable as direct labor if you track your hours and you keep track of which hours you spend on which job. But for the sake of this example, the owner doesn't want to do that, so they're going to track their hours, they're not going to track their hours, and it's just going to be included as an overhead expense. Other than that, you have your vehicles, including the depreciation of 4%. And for your total, your overhead makes up 26% of your total revenue. You take away your taxes, and your net profit is 17% of total revenue. I'd say in general that is a generally good proportion of the income statement here. Like having your cost of goods sold be around 50, I guess, is kind of the target for the market. And then overhead expenses at 25 is not bad. Of course, every business is different, and the best business is going to be able to completely optimize their overhead expenses to make those super minimal. And that would derive a higher net profit at the end of the day. Of course, your tax rate too is going to take a certain amount of income out of your business or money out of your business, and that's just something you have to deal with. But yeah, I'd say in general, this business is looking okay for their proportions. It's not like their overhead is eroding too much of their revenue, but at the end of the day, it's going to be up to you and the specifics of your business to determine whether your overhead level is eroding too much of your profits or not. So yes, I'm kind of going on a bit of a tangent, but the idea is to is to show you how a conversation about a profit and loss might happen. We look at the numbers first and we don't really cast necessarily objective judgments to that profit and loss. We want to break them down to percentages to really see like, okay, what are the most significant accounts that are taking away from my profit? And then you need to think like a business owner and look at these specific accounts and say, okay, is my direct labor expense more than I anticipated when I priced these jobs out for the year? Or do I think I can get it lower? Or maybe I get it higher and that in turn can produce more revenue if I hire another guy, say I expand another crew. The same goes for materials. Am I spending too much on material? Is there a lot of material waste that's rising up the cost of my materials? Maybe I can improve the efficiency of that, or maybe I can use cheaper materials without sacrificing the quality of my work. As you get into overhead, you can look at overhead expenses and determine, things like your vehicle expenses or your advertising and marketing budget. Perhaps more advertising, that is more overhead, could generate more revenue, allowing you for greater profits. Or perhaps buying another vehicle could do the same thing, allows you to get a second crew out in the field, generating more revenue for just a little bit of extra expenses. Or it may work the other way. Maybe your advertising is super inefficient, or you're paying really expensive truck payments and those are taking away from your overhead or from your profit, where you could decrease those budgets and recapture the savings as profit. As a business owner, you have to understand, am I maximizing the efficiency of my dollar? Is the money that I'm putting towards vehicles, towards marketing, towards materials and labor, are they optimized? Can I increase that spending to drive further profits, or do I have to dial back on that spending to save more and increase my profits that way? Or perhaps they're good as the way they are and I need to keep an eye on my pricing and an eye on my cost to make sure that I maintain this efficiency. That's phase one of thinking like a business owner. Phase two here is looking into the markup versus margin. So the income statement, I'll prevent some distraction here. The income statement works best when it's used alongside other financial statements and when it's compared over a duration of time. Looking at one is better than looking at none, but really looking at the trends in your income statement or looking at how it compares to your budget or your estimates is really going to help you understand if you're staying on track or not. For the sake of today, we're going to look at a company that has this exact income statement, doesn't do a budget, but they obviously estimate their jobs and they estimate them in a decent amount of detail. So let's first look at their gross profit and how that relates to the markup on a job. So let's say what I described is that fits the bill for you, right? You have your income statement in front of you. It's in decent shape. The accounts make sense. You don't do a budget rigorously, but you do estimate your jobs in quite a bit of detail. Well, here's how you can use your profit and loss statement to compare or to look at the success of your jobs and see if you're on track with your estimates. I want to look at the markup, or I want to look at the gross profit and compare it to what my markup is. So in this income statement, you can see that the gross profit makes up, the gross profit is 46%. So 54% of my revenue is used to pay for the expenses for that specific job. Now think back to your pricing formula or the way you like to do pricing. What's your markup? When you price out a job, do you write down your labor, your materials, your subcontractor expenses, and then times it by 2? Do you do 100% markup on your jobs? This right here is going to allow you to see if you're accurate in your markup. So, let's say for this company, for example, let's say that this was their markup strategy, right? They were doing 100% markup. Well, what does 100% markup relate to as a gross profit? Right here is the table that shows you exactly that. So if you're marking up your jobs at 100%, you're doubling the cost of the direct expenses to derive a price. Your margin, your gross profit margin, should read 50%. If this business was doing that, you can see here that their expenses were just a little bit high. So their gross profit margin was 46% instead of 50%. You can relate that back and say, okay, at a gross profit of 46%, what would my theoretical markup be? And in this example, it would be equivalent to you marking your prices up by 85% instead of 100. So right there, if you run those same numbers for your business, you can tell, okay, am I on track with what my pricing suggests? Am I marking things up accurately, or am I accurate in the amount of money it's going to cost me to provide this service? And to do this, simply, this is the formula here for markup versus margin. And you're going to start with your margin. So if your margin is 46%, as you can see here, your gross profit margin, if you want to calculate the markup, you take the margin divided by 1 minus the margin, and you can see that your markup is 85%. If your intention was 100, well, then you need to rework your pricing. You need to rework your markup model in order to accurately capture the true value of the cost of providing that service. That's all I want to cover today about thinking strategically around the income statement. Of course, we didn't even look at overhead. We're going to cover a lot more videos on the relationship between overhead and COGS and how that contributes to your job's profitability. But for now, that's going to be step 2 in thinking like a business owner and really using the profit and loss statement to your advantage. I want you to take the gross profit, compare it to your pricing model or how you generally mark up your jobs, and see if you're under or overshooting. From there, you can start making decisions around what you're going to look into next, whether it's the price of your materials, the price of your labor, or how to be more efficient. And in the future, we're going to look at overhead and how overhead really can take away the profitability out of your business, even when your gross profitability is super high. So stay tuned. I'll try to keep the links updated in the comments or in the descriptions as I expand my video portfolio. But for now, stay tuned. You'll see more videos on job costing, on the income statement, and perhaps I'll include some more different financial statements that you can look at as well. Like, comment, subscribe. Please message me if you have any questions or if you want a tool to be able to do this stuff yourself. I'm more than happy to make them all for free. Just shoot me a line. My contact information is in the description here. Thanks for tuning in, and I'll see you next time. Cheers.